Okay, so delivery of Monday's class is going to be through this asynchronous video. I know that we have assignment question 13-5, I believe it was, that we carried over from the last class. For that question, I would like you to attempt it on your own, and I'm going to post the solution on LMS. So this video is going to go through the rest of the Chapter 13 PowerPoint, get started on a few of the in-class assignment questions, and then we will finish the rest of those up tomorrow, which is Tuesday. So we left off after looking at short-term and long-term debt in Friday's class, and we left the PowerPoint where we were starting to talk about foreign exchange issues. So many Canadian companies borrow from foreign lenders, most commonly U.S. So transactions are channeled through U.S. banks and other financial institutions, as well as the U.S. bond market. Borrowing from foreign lenders adds an additional form of risk to the borrowing and causes gains or losses when exchange rates fluctuate. To offset the risk, companies can use hedging, which involves arranging equal and offsetting cash flows in the desired currency. So hedging isn't something that we go into great depth in this chapter or course, really. We talk about it a little bit more in Chapter 15, but it is certainly not the focus. So when it comes to accounting for exchange rate fluctuations, the underlying valuation of foreign currency monetary liabilities is that they should be reported on the balance sheet in the equivalent amount of reporting currency at the spot rate on the reporting date. So that is a very complicated way of talking about what we looked at in last class, where we look at the exchange rate on the date of the transaction. We adjust at the end of the accounting period and adjust again for the exchange rate when it is actually paid off. So the loan principal is originally translated into Canadian dollars on the date that it is borrowed at the current or spot exchange rate. At every subsequent reporting date, the loan is reimbursed at the then current rate. Remeasured at this current rate. If exchange rates have changed, we'll have an exchange gain or loss. So this is included in earnings in the year in which it arises. If exchange rates are particularly volatile, it can result in fairly large fluctuations to earnings. Annual interest, also denominated in the foreign currency, is accrued using the average exchange rate in effect during the period. When it is paid, cash outflows are measured at the exchange rate in effect on that day. So the difference between the expense and the cash paid is also recorded as an exchange gain or an exchange loss. Looking at an example of this, we have a 5-year loan at 1 million euros that was issued on January 1st at 5%. So it's recorded at the time of issuance based on the January 1st current exchange rate, in this case $1.40 Canadian for every 1 euro. So we see that increase to our cash and that increase to our long-term debt liability, again recorded in Canadian currency. At December 31st year end, we adjust for the then current exchange rate of $1.60 Canadian for every 1 euro. So the difference between our initial recording on January 1st and the amount at December 31st is what we record, in this case 200,000. So that difference is recorded as an exchange loss and an increase to our long-term debt. At December 31st, we also accrue interest based on the average rate for the year. So here is the difference. Previously, we're looking at the exchange rate on the specific date. When it comes to interest, because interest is accrued every day, we look at the average exchange rate between those two dates. So in this case, the average exchange rate was $1.52 Canadian for every 1 euro. So first we calculate the payment in the original currency, 1 million euro multiplied by 5%, and then multiplied by the average exchange rate, recorded as an increase to interest expense and an increase to our interest payable. When the interest is paid at the spot rate, we use the exchange rate of that day, so in this case, $1.60. We're going to decrease the interest payable by $76,000 record the exchange loss of 4,000, and then record the disbursement of 80,000 Canadian dollars. If the interest is not due at year end, the interest payable account is adjusted to the year end spot rate, and again, an exchange gain or loss would be recognized. So we now switch over to talking about capitalization of borrowing costs. So any cost that is directly attributable to the acquisition, construction, or production of a qualifying asset forms part of the cost of that asset and is capitalized. This is consistent with the general principle that all acquisition costs, including all costs of getting the asset ready to use, are appropriately part of its capital cost. Borrowing costs can be capitalized for non-financial assets such as inventories, intangible assets, machinery, and office or manufacturing facilities, but not for financial assets such as investments. Borrowing costs can be capitalized for sale due to construction, customization, or shipping. For example, inventory that is manufactured over a short period of time is not eligible for borrowing cost capitalization. Also, if an asset is ready for its intended use when it is acquired, no borrowing costs can be capitalized. For inventories at fair value, such as biological assets that occur with the agricultural sector, like agricultural produce, or manufactured in large quantities, the choice to capitalize borrowing costs is left to the companies to choose whether to capitalize or not, depending on their reporting objectives and the circumstances. Borrowing costs that can be capitalized are interest and any cost an entity incurs in conjunction with borrowing funds, such as upfront fees and foreign currency adjustments. Borrowing costs can be capitalized if it would have been avoidable if the acquisition was not made. If there is a specific loan in place to finance the acquisition, identifying borrowing costs is fairly straightforward. If a qualifying asset is purchased from general borrowings, however, rather than a specific loan, the calculations become more complex because it's harder to associate the borrowing with the acquisition itself. In this case, the average borrowing rate is calculated on the total general borrowings, and this rate is applied to the specified expenditures made for the time period involved. Capitalization begins when three criteria are met: when money is borrowed, a payment is made on an asset, and activities begin that will make the asset ready to use. Capitalization ends when the asset is put into use or is ready for its intended purpose, or if the work is not progressing. If work is stopped because of a strike or other delay that is unplanned, capitalization is not permitted for the idle time period. So your textbook provides an example on the bottom of page 916. But honestly, I think this takes some wrapping your head around. So before working on an example, I do have a video that I'm going to post to the LMS in regards to capitalization of borrowing costs. So we're going to finish up the few slides that we have left. Then you can go watch the video. And after that, I'll record a second video for the in-class assignment. So the last thing that we're going to talk about is looking at debt retirement. When debt is recorded in the accounts, it is recognized. When it's removed from the accounts, it is derecognized or extinguished. So the majority of financial liabilities are derecognized because the company pays the amount of the liability to the creditor or the bondholder at maturity. But sometimes debt is repaid and derecognized before its maturity date, either by arrangement with the debt holder or through open market transactions. Debt retirement at maturity is fairly clear-cut. By the time the debt reaches full maturity, all of the related discount or premium is fully amortized, making the carrying value of the debt equal to its face value. Any debt issue cost will be fully amortized. So there's no gains or losses to be recorded. We simply reduce the liability and the asset given in repayment.
Any costs incurred to retire the bond, such as trustee management fees, clerical costs, or payment fees, are immediately expensed. However, sometimes borrowers retire debt before maturity to improve their ratios or eliminate any debt covenants. So bonds may be purchased on the open market. The issuer pays the fair value of the bond, which is the present value using current market interest rates, as would any investor purchasing bonds. Bonds may also be redeemable, which means that the borrower may pay back the loan using a call option that sets a specific price at a specific time prior to maturity. Bonds may also be retractable, which means that the investor may force repayment. If a bond carries a call privilege, the issuer may retire the debt by paying the call price or redemption price during that specified time period. Typically, the call price will exceed face value by a certain percentage, which may decline each year of the bond term. For example, if the call premium were 5%, a 100,000 bond would be redeemed for a payment of 105,000 plus any accrued interest. A major factor in retiring bonds before maturity is the change in fair value that is caused when market yield rates change. Open market retirement prices are based on this fair value. So when interest rates increase, the fair value of an existing liability will decline because the yield rate has risen. Whether the retirement happens or not, the fair value of the bond has still changed. So I've taken a snip of an example from your textbook to demonstrate because the original PowerPoint didn't include one. So it's located on page 919 of your textbook if you want to take a little bit of a closer look at it. So we're going to examine the following cases relating to a 500,000 5% bond, originally sold to yield 6%, that pays interest semi-annually and has 18 periods left to maturity. So you can see case 1 and case 2, where we have those two different yield rates. In case 1, it is now 7%, and in case 2, it has fallen to 4.5%. So we can see the bond carrying value at the amortized cost, at the present value. Based on the market interest rate, we calculate the retirement price based on that fair value and record a gain or a loss. So you can see where that yield rate increased from 6 to 7%, we have a gain of 31,564, but where that yield rate has decreased, we're going to have to record a loss. So the text says that if market interest rates increase, causing bond prices to fall, firms could retire existing bonds by buying them on the open market. This triggers a gain and immediate higher earnings. For example, in case 1, the market interest rates are now 7%, and this bond with a book value of 465,616 can now be retired on the open market for 434,052. This results in a gain of 31,564. Since a replacement bond will have the same fair value as the old bond, this is an economic decision that is value neutral. However, it has a distinct accounting implication because of the gain that is recorded. If interest rates decrease, causing the bond price to rise, firms would retire existing bonds at a loss. So earnings will fall in that retirement period. So we see this with case 2, with that market rate falling to 4.5%. So now we're going to consider the impact of a call provision. So a call provision at the company's option protects the company from changes in fair value that is caused by a decline in interest rates. If the 500,000 bond that we just looked at specified that the company could call the bond for 102% of par, the highest value to be paid out would be 510,000. This fair value has an implicit yield rate of approximately 4.7% when we use an N value of 18 and caps the fair value of the liability at this level. If market rates fall below 4.7%, the company would have an economic, if not accounting incentive to retire. The real frustration is that retirement at $510,000 would still trigger an accounting loss. So this is the result when the accounting system is based on amortized cost rather than on fair value. So accounting for debt retirement prior to maturity involves the following. First, update interest expense to the retirement date through recording interest payable, discount or premium amortization, and the related debt issue costs. We remove the liability accounts, including the appropriate portion of the unamortized premium or discount and bond issue. We record the transfer of cash, other resources, or the issuance of a new debt security, and record any gain or loss that results. A gain or loss on bond retirement is classified either as an ordinary gain or loss or as a separate line item, depending on its frequency and the circumstances surrounding the transaction. A gain or loss is deferred and amortized over the term of any replacement debt if the transaction is a substitution or a modification of that existing debt. Extinguishment of debt may also be achieved through what we call defeasance. So this is a transaction that may be used to engineer derecognition of a bond liability without formally repaying it. Defeasance requires the company to transfer investment into an irrevocable trusteed fund. The trustee is then responsible for interest and principal payments on the debt using money generated by the investment. For this to happen, the original bond indenture will contain a provision that permits the corporation that issued the bond to set up the trust. If and when a trust is set up and fully funded according to the terms of the bond, accounting standards allow the liability to be derecognized. The bonds still exist, but the trust assumes all responsibility for them and the issuer has no further liability. The entry to recorded defeasance is a debit to the liability account and a credit to cash or investments, with a gain or loss recorded for any difference in amounts. So for example, and again, I pulled this from your textbook to show the example. We assume that a bond with a par value of $100,000 and remaining unamortized premium of $6,000 is defeased according to the terms of the bond indenture for $92,600. This represents the present value of the bond payments, discounted at market rates, or the investment required in interest-bearing securities that will yield interest and principal amounts sufficient to cover the required future cash flows. Note that market yields must have increased to the extent that investments of $92,600 will in fact generate sufficient cash over time to both pay the bond interest and repay the principal at maturity. The entry is a debit to the liability for the par value, a debit to premium on bonds payable for the remaining balance, a credit to cash, and to gain on bond defeasance for the difference. In substance, defeasance refers to the practice of establishing a trust for bond interest and principal repayment, even though the original bond indenture does not specify that defeasance can occur. In this case, the trust is not irrevocable since the company establishes the trust without creditor permission and sometimes without their knowledge. Since the creditor has not approved the defeasance, there is no legal release of obligation, so the liability is not removed from the balance sheet, and a separate investment account is recorded for funds transferred to the trustee. So earlier we mentioned substitution or modification of debt. A company may go to an existing lender and essentially repay and reborrow in one transaction, replace an existing loan prior to its due date. The motive may be a desire to borrow at a different interest rate, record movement in fair value of the existing obligation, or a release of a restrictive covenant. If the exchange results in significantly different terms, the company must record an extinguishment and a new loan with the two transactions being accounted for independently. This occurs if the present value of the new loan is at least 10% different from the present value of the old loan including fees and transaction costs. Any remaining unamortized fees and any fees incurred on extinguishment are expensed. If there's less than 10% gain or loss on retirement is recorded and the balances of the old loan are simply rolled to the new. Any additional fees would be added to any remaining unamortized fees from the original debt and amortized over the remaining term of the modified liability. So changes in long-term debt trigger disclosure on the statement of cash flows and also require significant disclosure. The statement of cash flows will reflect cash paid and cash received. In the financing section, any cash inflows from issuance of bonds or cash outflow to repay bonds. The operating section includes adding back any loss on bond retirement and deducting any gain, adding back discount or premium amortization, and adding back interest expense. Interest paid may be shown as either a financing or an operating activity. Most liabilities are financial instruments that require extensive disclosure, including title of issue, the interest rate, aggregate amount of payments required in the next 5 years. If the debt is denominated in a foreign currency, secured liabilities must be shown separately, and the fact that they are secured. Fair value of each class of financial liability and method used to establish it, and any details of defaults. The objectives, policies, and processes for managing risk and managing capital must also be disclosed. Treatment of long-term liabilities is similar under IFRS and ASPE. There are some differences in terminology and approach, but the impact of the differences is not significant. So there's two major differences to note. The first is in the capitalization of borrowing costs. It's not required under ASPE. So ASPE includes no guidelines governing the kinds of borrowing costs to be capitalized, commencement or completion dates, or determining the costs of general borrowing pools. Companies must disclose policy in the area and the extent of interest capitalized, although this disclosure is less onerous under ASPE than it is IFRS. ASPE also allows for the use of the straight line method to unwind a discount or premium. Straight line amortization is also permitted for upfront costs. The effective interest method is permitted, but is not required. Exhibit 13-0.9 on page 928 of your text summarizes the differences between effective interest and straight line methods. We're not going to go into it in detail, but give that table a quick read over. So to summarize everything that we've talked about in Chapter 13, debt financing includes financial leverage in a company's capital structure and increases financial risk. Short-term financing is available through trade credit, promissory notes, and short-term bank loans of various kinds. Long-term financing can be sourced through financial institutions or capital markets. Common loan vehicles are term loans, commercial mortgages, and bonds. Long-term debt often involves debt covenants to provide reassurance and recourse to lenders. Covenants include accounting-based covenants and restricted actions. Long-term debt is usually classified as a financial liability in the other financial liabilities category and is carried at the amortized cost. So that brings us to the end of Chapter 13. Like I said, I'm going to post a video on LMS from YouTube that talks about capitalization of borrowing costs. And then I'm going to do a second video where we go over the in-class assignment portion. Actually, you know what? There's not that many questions left, and we have one more class dedicated to Chapter 13. So instead, I'm going to say, watch the video on capitalization, and then in Tuesday's class, we will do the rest of the in-class assignment questions. Okay, so really just looking at the content, reading the textbook pages that relate to it, and that little extra video is all you have for today's